Secured debt. Secured debt is debt that is backed by an asset called collateral. This means that if you fail to repay the loan, the lender has the legal right to take that asset from you. The most common examples are mortgages, where your house is the collateral, and car loans, where your vehicle is the collateral. Because the lender has a safety net, secured debt usually comes with lower interest rates than unsecured debt. Unsecured debt. Unsecured debt has no collateral backing it. The lender gives you money based purely on your promise to repay and your credit history. Credit cards, student loans, and medical bills are the most common forms. Because the lender takes on more risk, interest rates are typically higher. If you default, the lender cannot automatically seize your property. They have to sue you first. Revolving debt. Revolving debt is a type of credit that does not have a fixed number of payments. You are given a credit limit and you can borrow up to that limit, repay it, and borrow again repeatedly. Credit cards are the most classic example. A home equity line of credit, also called a HELOC, is another. The danger of revolving debt is that it never has to end. You can stay in it indefinitely if you only ever make minimum payments. Installment debt. Installment debt is the opposite of revolving debt. You borrow a fixed amount of money and repay it in equal scheduled payments, called installments, over a set period of time. Mortgages, car loans, student loans, and personal loans are all installment debt. Once you pay it off, the account is closed. Mortgage debt. A mortgage is a secured loan used specifically to purchase real estate. You pay it back over a long period, typically 15 to 30 years, with interest. Your home is the collateral, meaning the bank can foreclose and take your house if you stop paying. Mortgages are often the largest debt a person will ever carry in their lifetime. There are two main types: fixed-rate mortgages, where the interest rate never changes, and adjustable-rate mortgages, where the rate can go up or down over time. Student loan debt. Student loan debt is money borrowed to pay for higher education. It can come from the government or from private lenders. Government student loans usually have lower interest rates and more repayment options. Private student loans function more like personal loans and can have much higher rates. Student loan debt has become a global crisis. In the United States alone, borrowers collectively owe over $1.7 trillion. Credit card debt. Credit card debt is one of the most dangerous forms of consumer debt because of its extremely high interest rates, which often range from 20 to 30% annually. Many people use credit cards for everyday purchases and only pay the minimum each month, which causes their balance to grow rapidly through compounding interest. Credit card debt is unsecured and revolving, making it easy to fall into and very hard to get out of. Auto loan debt. An auto loan is a secured installment loan used to purchase a vehicle. The car itself is the collateral. Auto loans typically range from 3 to 7 years. One major risk is being underwater on your loan, meaning you owe more on the car than the car is currently worth, because vehicles depreciate very quickly in value. Personal loan debt. A personal loan is an unsecured loan given by a bank, credit union, or online lender for almost any purpose, consolidating debt, covering emergencies, or financing large purchases. Because it is unsecured, the interest rate depends heavily on your credit score. Personal loans have a fixed repayment schedule, unlike credit cards. Payday loan debt. Payday loans are short-term, extremely high-interest loans designed to be repaid on your next paycheck. They are targeted at people with no credit or bad credit who need fast cash. Annual percentage rates on payday loans can exceed 400%. They are widely considered predatory because many borrowers cannot repay them in time and are forced to roll the loan over, accumulating enormous fees. Many countries have moved to ban or heavily restrict them. Medical debt. Medical debt arises when a person cannot pay their healthcare bills. It is one of the leading causes of personal bankruptcy in the United States. Unlike most debt, it is often unexpected. Nobody plans to get sick or injured. Medical debt is generally unsecured and is sometimes negotiable with hospitals or written off entirely. Business debt. Business debt is money borrowed by a company to fund its operations, expansion, or assets. This includes business loans, lines of credit, bonds, and invoice financing. Unlike personal debt, business debt is evaluated on the health of the company rather than an individual's credit score. Healthy businesses use debt strategically to grow, but too much of it can lead to bankruptcy. National debt or sovereign debt. National debt, also called sovereign debt, is the total amount of money a government owes to its creditors. Governments borrow by issuing bonds to domestic citizens, foreign investors, and international institutions like the IMF. National debt is used to fund everything from wars to infrastructure to social programs. When a government cannot repay its debt, it can default, which can trigger a full economic crisis, as seen in countries like Argentina and Greece. Good debt versus bad debt. Not all debt is equal. Good debt is money borrowed to invest in something that will increase in value or generate income over time, like a mortgage on appreciating property or a student loan that leads to a high-paying career. Bad debt is borrowed to purchase things that lose value quickly or provide no financial return, like a credit card balance from a vacation or a payday loan taken for everyday expenses. The key difference is whether the debt is building your future or draining it. Debt consolidation. Debt consolidation is the process of combining multiple debts into one single loan, usually at a lower interest rate. Instead of making 5 different payments to 5 different creditors, you make one payment. This can simplify repayment and reduce the total interest paid over time. However, it is not a cure. If the spending habits that created the debt do not change, the problem will return. Debt default. Default occurs when a borrower fails to meet the legal obligations of their loan, typically by missing payments for an extended period. For individuals, defaulting on a loan can destroy your credit score, result in lawsuits, wage garnishment, or repossession of assets. For a government, defaulting on sovereign debt can collapse its currency, trigger hyperinflation, and cause a nationwide economic emergency. Subscribe to more like this